There is a silent mistake most traders keep repeating, often without even realizing it. It doesn't show up in their charts, it doesn't appear in their indicators, and it isn't something their broker can warn them about. It lives quietly inside their mindset. The compulsion to re-enter the same trade over and over again simply because the market didn't behave the way they expected. This habit, known as repeated entry, is one of the most underestimated psychological traps in trading. It feels harmless, even logical at times, but it slowly conditions the trader to chase the market instead of understanding it. When a trader avoids repeated entry, they are not avoiding opportunities, they are avoiding emotional decisions disguised as opportunities. Every time you jump back into the same trade after being stopped out, your mind is no longer operating from clarity. It is operating from the need to prove something, prove that your analysis was correct, prove that the market should have moved your way, prove that you can make back what you just lost. This proof-seeking mindset transforms the market from a neutral environment into a battleground where your ego fights against reality, and reality always wins. The market doesn't reward stubbornness, it rewards alignment. When you enter, exit, then immediately re-enter the same idea, you are telling the market that you are not responding to what it is showing you. You are responding to what you want it to show you. This disconnect is the birthplace of frustration, revenge trades, impulsive actions, and eventually account damage. Avoiding repeated entries is not about being overly cautious. It is about developing a mature relationship with uncertainty. A trader who understands uncertainty knows how to wait. They know that missing one trade doesn't matter. They realize that the market is an endless stream of opportunities, but their capital is not. When you avoid repeated entry, you shift from "I must catch this move" to "I must preserve my ability to participate in future moves." This mindset is not defensive, it is disciplined, and discipline is the only structure that protects a trader from emotional chaos. Every trade carries information. When your setup fails, the market is communicating something important. It's telling you that conditions have changed, that your interpretation was incomplete, or that timing was off. Repeated entry ignores this information. It replaces observation with force. It makes the trader deaf to the one voice that matters, the market's. When you stop repeating entries, your mind becomes freer to analyze rather than react. You begin noticing subtle shifts in momentum, market tone, liquidity, and behavior. You start to see that trading is not about being right, but about staying available for the moments when your edge truly aligns with the market. Avoiding repeated entry is ultimately about breaking the cycle of emotional impulse. It is about stepping out of the illusion that the market owes you something. It is about mastering your response to uncertainty rather than trying to control the market itself. Avoiding repeated entries to prevent emotionally driven decisions is one of the most transformative principles a trader can internalize because it directly challenges the part of the mind that reacts fastest and thinks the least, the emotional mind. When a trader gets stopped out of a position, the immediate impulse is rarely driven by analysis or logic. It comes from a surge of emotion, frustration, disbelief, irritation, or the desire to prove the original idea right. This emotional spike makes the trader feel as if re-entering quickly will fix the mistake or capture the move they believe the market should have made. But the market does not operate on shoulds. It operates on behavior, structure, and order flow. When you allow emotions to dictate an immediate re-entry, you disconnect yourself from the actual information the market is presenting. Instead of responding to real-time conditions, you respond to your internal discomfort. Emotional decisions in trading are dangerous because they happen faster than rational thought. A trader might spend hours planning a setup, analyzing levels, studying market context, and defining risk. But the moment the stop loss is hit, all that preparation can collapse under the weight of a few seconds of emotional impulse. Repeated entry becomes a reflex, not a strategy. It becomes the trader's way of trying to erase the feeling of loss rather than understanding why the loss occurred. This is why repeated entry is so harmful. It bypasses every layer of discipline the trader has built and replaces it with a split-second emotional reaction. When the emotional mind is in control, the trader is no longer participating in the market. They are fighting a psychological battle within themselves, attempting to soothe a wound by forcing a trade. The danger of emotional re-entry is amplified by the illusion of opportunity. When you just exited a trade, especially a losing one, the idea often feels more powerful than it actually is. You convince yourself that the market only made a temporary shakeout. You tell yourself that the real move is still about to begin. This thought does not come from logic, it comes from hope. The mind creates justifications to support what it wants to feel. The trader wants to believe they were right. They want to avoid the discomfort of accepting the loss. They want to prove their analysis wasn't flawed. As a result, the re-entry feels justified, even though it is built on emotion rather than market structure. And once a trader acts on this emotional narrative, they reinforce the belief that emotional decisions are acceptable, which sets the foundation for long-term destructive habits. Another subtle reason repeated entry is dangerous is because it conditions a trader's psychology in the wrong direction. Each time you re-enter impulsively, you teach your brain that action is the solution to emotional discomfort. The more you do it, the more automatic it becomes. Instead of pausing, observing, and reassessing, the brain learns to respond with speed and aggression. Over time, this conditioning erodes discipline. It makes it harder to follow rules, harder to trust stops, and harder to maintain objectivity. Emotional decisions become habitual, and the trader feels increasingly out of control. But the truth is, they train themselves into that state through repeated emotional entries. It's also important to understand that repeated entry reduces the quality of your edge. Each trading edge is built on a set of criteria, conditions, or behaviors the market must present. When those conditions disappear, the edge weakens or collapses entirely. Once your initial trade fails, the original conditions have changed. If the entry signal was still valid, your stop wouldn't have been hit. If the market still aligned with your idea, the setup wouldn't have broken down. A re-entry, therefore, ignores the fact that the edge is no longer present. You are entering without the criteria that originally gave you a high probability setup. This is why repeated entries often lead to a streak of losses. You are trading without an edge, guided only by emotion. The market is indifferent to your emotional state, so it keeps behaving as it should, while the trader keeps acting from impulse, creating a widening gap between reality and their decisions. Another issue with repeated entries is the unseen psychological pressure that builds after each attempt. If a trader re-enters once and loses again, stress increases. If they re-enter a second time and lose again, frustration grows. A third re-entry elevates tension into urgency. At this stage, the trader is no longer trying to capture a setup, they are trying to escape a psychological spiral. The mind becomes clouded. The heart rate increases and decision-making collapses into desperation. This state is where traders experience their largest losses. By trying to undo past mistakes, they compound them. By trying to regain control, they lose more of it. Emotional re-entry creates a chain reaction, turning one small controlled loss into a dangerous cycle of impulsive trading that can drain confidence, capital, and mental stability. Avoiding repeated entry protects a trader from this spiral. When you commit to avoiding immediate re-entry, you force yourself to disrupt the emotional impulse. You create a psychological buffer between the loss and the next decision. This pause is one of the most powerful tools a trader can develop. In the pause, clarity returns. The mind recenters. You can look at the chart objectively again. Instead of reacting to what just happened, you can assess what is currently happening. You can evaluate whether the market is trending, ranging, reversing, or behaving erratically. You can ask yourself whether a fresh setup is forming or whether conditions are unfavorable. This shift from reaction to observation restores your sense of control and brings you back into alignment with your trading edge. Avoiding repeated entries also strengthens emotional resilience. It trains the mind to accept losses without immediately seeking relief through another trade. This acceptance is foundational for long-term success. Every trader encounters losses, it is unavoidable. What determines growth is how the trader processes those losses. If a trader tries to erase them, they create instability. If they observe them, learn from them, and move forward with patience, they develop a resilient mindset. Avoiding repeated entry reinforces this resilience by breaking the cycle of emotional reaction and replacing it with deliberate, thoughtful decision-making. When traders learn to avoid repeated entries, they also begin to understand that the market is not a place to resolve emotional discomfort. It is a place of probabilities, risk, and opportunity. Emotions are natural, but they should not dictate action. The ability to separate feelings from behavior is what positions a trader for longevity. Emotional decisions are short-term reactions. Disciplined decisions are long-term investments in your process. Avoiding repeated entry ensures that your actions come from discipline, not emotion. A failed setup is information, not an invitation to re-enter, and this single shift in perspective separates the trader who evolves from the trader who keeps repeating the same emotional loop. When a setup fails, the market is communicating something important. It is revealing that the underlying conditions you believed were present either no longer exist or perhaps never existed in the way you interpreted them. Many traders overlook this message because they are too focused on the emotional impact of the loss rather than the informational value behind it. The loss feels personal, as if the market rejected their idea or exposed a flaw in their judgment, but the market has no awareness of the trader. It only reflects changing conditions. The failed setup is simply a neutral event, a moment where the trader's expectation did not align with the market's behavior. The true problem begins when the trader refuses to accept this information and instead re-enters impulsively, attempting to force the same idea onto a market that has already invalidated it. The moment a setup fails, the psychological tension inside the trader rises. That tension is the mind's resistance to accepting that the scenario it believed would unfold is no longer valid. Most traders misinterpret this discomfort as a sign to take action. They believe that entering again will either redeem the original idea or recover the loss quickly. But this interpretation is emotional, not analytical. The failed setup is not a signal to act, it is a signal to pause. It is a moment to reassess the environment, examine what changed, and observe how the market responded to the levels, patterns, or behaviors you were relying on. Traders who understand the informational value of failure use it to refine their edge. They recognize that each failed trade is part of a broader pattern of feedback that strengthens their understanding of market conditions. When a trader immediately re-enters after a failed setup, they effectively ignore the information the market is giving them. It is equivalent to covering your ears while the market is speaking. The market's message might be that volatility is expanded, making your stop too tight. It might be that momentum is shifting, creating a structural change. It might be that liquidity is thinning, causing erratic spikes. It might simply be that the timing was wrong. Whatever the reason, the failed setup carries data that can improve future decisions. But when you treat the failure as an invitation to try again, you bypass the learning process and replace it with emotional reaction. You tell your brain that the loss does not matter, that reflection is unnecessary, and that the only answer is to take another trade. This mindset ensures that the trader repeats the same mistake again because they never processed the lesson embedded in the failure. The informational value of a failed setup becomes even clearer when you examine it through the lens of probability. Any trading strategy, no matter how robust, includes losing trades. Losses are not interruptions. They are built into the statistical model of your edge. Each loss is part of a distribution that defines long-term profitability. When a trader sees a failed setup as an invitation to re-enter, they disrupt this distribution. They treat the loss as something abnormal rather than something expected. This creates psychological pressure because the trader starts seeing losses as something to fix immediately, rather than something to understand over time. But when the trader views the failed setup as information, they stay aligned with the probabilistic nature of trading. The loss becomes feedback, not a flaw. It becomes data for adjustment, not fuel for emotional reaction. The biggest danger in treating a failed setup as a re-entry signal is that the trader becomes blind to context. Context is everything in trading. Your setup might have been valid 5 minutes ago, but market context might have shifted completely since then. A new candle structure may have formed, sentiment may have changed, a key level may have been absorbed, or momentum may have reversed. Re-entering without processing this new context means you are trading based on outdated information. You are trading the past instead of the present. This mismatch between market reality and trader behavior is the root cause of repeated losses. When a trader understands that the failed setup is information, they immediately shift into observation mode. They study the aftermath of the failure. They look at how price moved after stopping them out, how other participants entered the market, how liquidity responded, and how volume shifted. This observation provides clarity, allowing the trader to understand whether the failure was random noise, a structural break, or a complete invalidation of the original idea. Another powerful aspect of seeing failed setups as information is the emotional detachment it creates. When you look at the failure as data, not damage, your emotions lose their grip. Emotional trading thrives on narratives like "the market faked me out, I was almost right," or "I got unlucky." These narratives feed the ego and push the trader into re-entry mode. But when failure is seen as information, these narratives disappear. You no longer need the market to validate your idea. You no longer need to prove anything. You simply observe and learn. The failed setup becomes a neutral event, and neutrality is the foundation of disciplined trading. Traders who internalize this perspective begin to see patterns that others miss. They notice that certain types of failures often lead to consolidation, reversals, or trend continuations. They observe that specific timing windows increase the likelihood of stop-outs. They realize that failed setups near major liquidity pools have a different meaning than failures in the middle of a range. They begin to categorize failures, study them, and incorporate them into their decision-making. This level of awareness is impossible for traders who treat every failure as a cue to jump back in. Their minds are too occupied with emotional tension to observe the market with clarity. Seeing a failed setup as information also builds patience. Patience is not simply waiting, it is the ability to remain calm and objective while waiting. When you recognize that the failure is giving you insight into what the market is actually doing, you naturally slow down. You begin to respect the rhythm of the market. You wait for new, clean signals. You stop forcing scenarios. You start listening. This patience is what gives traders longevity. It prevents them from burning themselves out or damaging their account during periods of unfavorable market conditions. Finally, understanding a failed setup as information strengthens the trader's confidence in their process. Confidence in trading does not come from winning trades. It comes from consistent behavior rooted in rational understanding. When you treat failures as invitations, your behavior becomes random, reactive, and unstable. When you treat failures as information, your actions become consistent, grounded, and intentional. You begin to trust your ability to interpret the market rather than your ability to fight it. This shift forms the psychological foundation of a trader who can evolve, adapt, and survive in any market environment. Repeated entry shifts focus from discipline to ego, and this transition happens so subtly that most traders never notice it until they are already deep inside an emotional cycle they can't easily escape. In trading, discipline is the framework that keeps a trader aligned with probabilities, rules, and structure. Ego, on the other hand, pulls the trader into a psychological battleground where the need to be right becomes more important than the need to follow a plan. When a trader begins re-entering the same setup immediately after being stopped out, they are no longer trading from a place of clarity. They are trading from a place of personal attachment. The market is no longer a neutral environment. It becomes a test of identity, competence, and pride. This is the moment ego takes control, pushing discipline aside and convincing the trader that the next entry will finally vindicate their original idea. Discipline is built on acceptance. It is the acceptance that setups fail, that losses occur, that the market is unpredictable, and that no single trade carries any special meaning. But ego rejects acceptance. Ego views a failed setup as a challenge, a slight, or an insult. Instead of acknowledging that conditions have changed, the ego interprets the loss as something that must be corrected. It whispers that the market made a mistake, not the trader. It tells the trader to prove themselves, to show that their analysis was right all along, to take back control by forcing another entry. This shift in internal dialogue is what transforms a normally disciplined trader into one who trades emotionally. Repeated entry becomes the ego's tool for validation, not the trader's method for executing a well-defined strategy. The ego-driven trader begins to blur the difference between analysis and emotion. Before the loss, their plan may have been clear: wait for confirmation, manage risk, allow the setup to unfold, and respect the stop. But once the stop is hit and ego enters the scene, the trader's priorities shift. Suddenly, the only thing that matters is being right. The trader no longer looks at the chart with objectivity. They look at it with a need for vindication. Every small movement in their original direction feels like a sign, a reason to re-enter, a justification that the market is still aligned with their idea. This interpretation is not based on analysis. It is based on ego searching for evidence to support its narrative. It turns the trader's focus inward, away from the market's behavior, and toward their own emotional discomfort. As ego grows stronger, discipline weakens. The rules the trader once followed begin to feel restrictive or unnecessary. Why wait for a new confirmation when the market should move in the expected direction? Why respect the stop when the trader knows the market will eventually return? Why sit out after a failed setup when re-entering feels like the fastest way to restore confidence? Ego makes these questions sound logical, even though they are emotional traps. Each time the trader re-enters impulsively, they reinforce the idea that emotion-driven decisions are acceptable. This reinforcement is dangerous because it reshapes the trader's identity. They begin to believe that they are supposed to win immediately, that losing is unacceptable, and that their ideas must always be validated. This distorted self-perception destroys discipline because discipline requires humility, patience, and the willingness to wait for the market to present a new opportunity. Ego thrives on immediacy. Discipline thrives on timing. Ego wants action now. Discipline wants the right action at the right moment. When repeated entry becomes a habit, timing is abandoned. The trader is no longer waiting for the market to show alignment. They are trying to impose alignment through force. This force manifests as rapid-fire entries, oversized positions, or impulsive decisions made in frustration. The market, of course, does not respond to force. It simply continues in its natural rhythm while the ego-driven trader fights against movements they cannot control. This is why repeated entry often leads to cascading losses. The more the trader attempts to assert themselves, the more the market exposes their lack of control. Another destructive effect of ego replacing discipline is the erosion of awareness. Trading requires awareness of volatility, momentum shifts, liquidity pockets, structural changes, and emotional tone. Ego blocks awareness because it narrows the trader's focus to a single objective, proving the original idea was right. This tunnel vision blinds the trader to information that would normally protect them. They ignore new reversal signals, dismiss changes in volume, overlook invalidation points, and rationalize unfavorable market behavior as temporary noise. Ego convinces the trader that the market will eventually comply, even though the evidence may clearly suggest otherwise. The longer the trader clings to the idea, the more disconnected they become from what is actually happening. Repeated entry also creates a false sense of control. Ego tells the trader that by re-entering again and again, they are staying in the game, not giving up or pressing their conviction. But control in trading does not come from forcing an outcome. It comes from managing actions within uncertainty. When ego takes over, the trader loses genuine control because their actions are no longer grounded in logic. They are acting from urgency, fear, frustration, or pride. These emotions cloud judgment, distort perception, and lead to decisions that violate the trader's own rules. The illusion of control becomes dangerous because it encourages the trader to continue re-entering even when the environment is clearly unfavorable. Another consequence of ego dominating discipline is the breakdown of trust in the trading process. Discipline requires trust. Trust in the rules, trust in the system, trust in the long-term edge. But when ego takes control, the trader stops trusting the process and starts relying on impulse. They begin to believe that they must personally intervene to correct every loss, that the rules are too rigid, or that following the plan is less important than following their feelings. This shift in trust destroys consistency. Without consistency, no edge can play out over time. The trader becomes trapped in a cycle where each repeated entry creates more emotional imbalance, which leads to more impulsive decisions, which further destroys trust in their own discipline. As ego takes over, the trader's identity becomes tied to individual trades rather than overall performance. Each entry becomes a reflection of their competence. Each loss becomes a personal failure. Each re-entry becomes an attempt to reclaim self-worth. This emotional entanglement makes losses feel heavier and wins feel like momentary relief. Trading becomes emotionally exhausting, and the focus shifts entirely from execution to validation. The trader is no longer participating in a probabilistic environment. They are trying to protect their sense of self through each trade. When repeated entry shifts focus to ego, the trader's long-term growth becomes impossible. Ego resists change because change requires admitting mistakes, reviewing behavior, and adapting. Discipline embraces change because it understands that growth comes from observation and refinement. The trader stuck in ego repeats the same pattern because the ego refuses to acknowledge that the pattern itself is the problem. They continue re-entering not because it makes sense, but because it feels emotionally necessary. The cycle repeats until the consequences become too painful to ignore. Preserving capital matters more than proving a trade idea right, and this truth is one of the hardest lessons for traders to internalize because it requires shifting from an ego-based mindset to a probability-based mindset. Most traders enter the markets with the unconscious belief that being right is the ultimate goal. They place emotional value on accuracy, pride, and validation. They feel a sense of accomplishment when a trade works exactly as they expected, and they feel disappointment or frustration when the market goes against them. This attachment to being right makes them forget the real purpose of trading, staying in the game long enough for the law of large numbers to work in their favor. Capital is the fuel that allows a trader to participate in opportunities. Without capital, the trader has no chance of recovering, improving, or applying their edge. This is why preserving capital is not just important, it is the foundation of survival. When a trader prioritizes being right over protecting capital, they begin taking actions that conflict with rational decision-making. They start holding losing trades longer than they should because closing the position forces them to admit they misjudged the market. They widen stop losses to avoid the emotional discomfort of being wrong. They double down or re-enter impulsively because their mind insists the market should validate their original analysis. These behaviors create unnecessary risk, not because the trade setup has improved, but because the trader's need for self-validation has intensified. The more emotionally invested a trader becomes in an idea, the more blind they become to the deteriorating conditions around them. What began as a structured setup turns into an emotional entanglement, where capital is sacrificed for the sake of maintaining pride. When you shift your perspective toward capital preservation, your entire decision-making process begins to change. Every trade becomes less about proving skill and more about managing risk. You begin to see losses as routine operating costs, not as personal failures. You stop measuring your competence on a trade-by-trade basis and start observing your performance across a larger sample of trades. This detachment is essential because it frees you from the emotional pressure that pushes traders into poor decisions. Preserving capital requires humility, the humility to accept that no matter how confident you are in a setup, it might still fail. Humility allows you to recognize that the market does not need to align with your expectations. It will do what it does, and your job is not to control it, but to adapt to it. Capital preservation is rooted in the understanding that markets are probabilistic. Even the best strategies have losing streaks. Even the most experienced traders misinterpret patterns, enter too early, or exit too late. The traders who endure are those who recognize that their edge only reveals itself over hundreds or thousands of trades, not in a single moment. Protecting capital ensures that you can survive the periods when the market is unfavorable, disjointed, or unpredictable. If you burn through your capital during emotional cycles, especially by re-entering repeatedly, you reduce your ability to benefit when conditions finally turn in your favor. Capital is not just money, it is opportunity, it is time, it is flexibility. The more capital you preserve, the more control you have over your future decisions. One of the most damaging effects of prioritizing the need to be right is the psychological pressure it creates. When a trader believes their analysis must be validated, each loss becomes emotionally heavy. Losing is no longer a natural part of the process, it feels like an attack on their identity. This emotional weight leads to fear, hesitation, anger, frustration, or revenge trading. These emotional states cloud judgment and push the trader to violate the very rules designed to protect capital. In contrast, when a trader internalizes that preserving capital is the primary objective, losses lose their emotional charge. A loss becomes nothing more than a small drawdown, a controlled expenditure, a statistical event. This psychological neutrality helps the trader maintain clarity, calmness, and control. Without emotional burden, decision-making improves naturally. Preserving capital also means respecting risk parameters without compromise. Whether the strategy calls for a 1% risk per trade or a fixed stop distance, the disciplined trader follows it without exception. They understand that small, controlled losses are part of the cost of doing business. They also recognize that once they allow a single emotional decision to bypass a rule, it becomes easier to justify doing it again. This is how traders drift into patterns of oversized losses. Capital preservation requires consistent application of risk management. It requires the trader to value longevity over short-term emotional comfort. Another important aspect of capital preservation is knowing when not to trade. Many traders believe that constant participation increases their chance of success. But in reality, overtrading drains capital faster than any individual setup. When the market is choppy, indecisive, or lacking clear structure, the disciplined trader stays out. They recognize that capital is preserved not only through well-executed entries, but also through strategic inactivity. Patience becomes a tool for survival. By waiting for conditions that truly align with their edge, the trader reduces unnecessary exposure and maintain psychological balance. The trader attached to being right, however, cannot tolerate waiting. Their ego demands action, and this need for constant validation leads to forced trades that slowly drain capital. Preserving capital also enhances flexibility. When you protect your equity, you maintain the ability to adapt your strategy, test improvements, adjust position sizing, or take advantage of rare, high-probability setups. You have options. In contrast, when capital is damaged, the trader becomes restricted. They may be forced to reduce size dramatically, miss opportunities they would normally take, or trade from a place of fear due to recent losses. A shrinking account narrows your possibilities, but a well-preserved account expands them. Flexibility is one of the most underestimated advantages in trading, and it begins with capital preservation. Another critical factor is psychological longevity. The trader who constantly risks too much or repeatedly re-enters in an attempt to force a win begins to experience emotional burnout. This burnout leads to impatience, confusion, and impulsive decisions, all of which further damage capital. But the trader who protects capital creates a stable emotional environment. They approach trading with clarity, not desperation. Their mind stays sharp because they are not constantly recovering from unnecessary emotional and financial setbacks. Psychological longevity supports consistency, and consistency supports long-term profitability. Preserving capital builds confidence in a way that being right never can. A trader who ties their confidence to accuracy becomes fragile because accuracy fluctuates. Every trader experiences sequences of wins and losses. If confidence collapses during losing streaks, the trader becomes unstable. But when confidence is rooted in disciplined execution, controlled losses, and strong capital management, it becomes unshakable. Confidence grows from knowing that you can endure volatility, survive losing streaks, and remain available for future opportunities. This form of confidence is sustainable because it is built on behavior, not outcomes. Ultimately, preserving capital matters more than being right because it is the only approach that supports longevity, stability, growth, and resilience in the markets. Without capital, you cannot survive uncertainty, cannot leverage opportunity, and cannot allow your statistical edge to play out over time. By protecting capital, you protect your future as a trader. Waiting for fresh conditions strengthens clarity and control, and this principle becomes increasingly important the more experience a trader gains. In the beginning, most traders believe that constant activity is what leads to progress. They feel an inner pressure to always be in a trade, always be catching a move, always be participating. This pressure is rooted in fear, the fear of missing out, the fear of falling behind, the fear of watching a move happen without them. But with time, it becomes clear that the market does not reward constant participation. It rewards selective participation. It rewards those who wait for alignment, not those who chase movement. When a trader learns to wait for fresh conditions after a setup fails or after a period of uncertainty, they begin to develop a deeper understanding of market rhythm. Waiting becomes a strategic advantage rather than a sign of hesitation. Fresh conditions bring clarity because they allow the trader to reset their perspective. Once a setup fails, the chart becomes temporarily contaminated by emotion. The trader's mind becomes clouded with bias, frustration, or lingering attachment to the previous idea. If they attempt to re-enter immediately, they carry this emotional residue into the next trade, making it harder to see the market objectively. But when they choose to step back, observe, and wait for new conditions to develop, the emotional fog begins to clear. The market reveals new information, new structures, new patterns, and perhaps an entirely different direction than the trader anticipated. This fresh information becomes the basis for rational decision-making, free from the distortions of the previous trade. Waiting also strengthens control. The moment a trader acts impulsively, they surrender control to emotion. They hand their decisions over to fear, impatience, or ego. But waiting, in contrast, is an act of self-governance. It is a conscious choice to prioritize discipline over impulse. Each moment spent waiting reinforces the trader's internal stability. It teaches the mind that it does not need to chase validation through constant trading. This internal control is what stabilizes the trader during volatile periods. It prevents rash decisions that lead to unnecessary losses. It also strengthens the trader's ability to execute their strategy consistently because they are no longer reacting to the market, but observing and responding only when their criteria are met. Fresh conditions provide a cleaner landscape for analysis. Price action must evolve, patterns must mature, and structure must reveal itself before high-quality opportunities emerge. When traders force entries too early, they are essentially trading incomplete information. They are acting before the market has communicated enough to justify risk. Waiting allows price to settle, volatility to normalize, liquidity to shift, and sentiment to clarify. It gives the trader space to interpret what the market is trying to do rather than what they want it to do. This separation between desire and reality is the foundation of professional-level clarity. Another benefit of waiting for fresh conditions is that it reduces noise. The market often behaves erratically after invalidating a setup. Sudden spikes, liquidity grabs, and range-bound movement appear as the market transitions from one phase to another. Traders who attempt to re-enter during this chaotic period are caught in the noise, stopped out repeatedly, or dragged into directionless price action. But the trader who waits for the dust to settle avoids this unnecessary turbulence. They allow the market to show its hand. They observe whether the move was a false breakout, a genuine reversal, or simply short-term volatility. Once the structure becomes clear, the next decision flows naturally from the chart rather than from emotional pressure. Waiting for fresh conditions also sharpens a trader's pattern recognition. When you give the market time to form new levels, break structures, or establish momentum, you begin to see more accurately whether your edge is present. You become better at identifying the difference between temporary fluctuations and genuine directional shifts. Over time, this ability to distinguish noise from signal becomes one of your greatest strengths. The trader who jumps back in repeatedly never develops this skill because they are too busy reacting to short-term movement. Their focus is on action, not observation. But the trader who waits learns to see deeper, to read context more clearly, and to understand the story behind price action. Control is further strengthened because waiting reduces emotional expenditure. The mind becomes exhausted when forced into rapid decisions, especially decisions driven by loss, fear, or frustration. Emotional fatigue leads to mistakes, hesitation, and inconsistent execution. But waiting acts as a mental reset. It allows emotional energy to stabilize. It gives the trader time to process the previous trade, reflect on what went wrong, and regain composure. This emotional reset is essential because clear decision-making cannot coexist with emotional turbulence. When the trader has regained control, their next entry is made from a centered state rather than a reactionary one. Waiting also helps the trader reconnect with their original strategy. After a losing trade or a sudden market shift, it's easy to drift away from the plan, to adapt rules out of frustration, or to take trades that fall outside the system. Waiting provides a moment to realign. It gives space to revisit the rules, reevaluate the criteria, and ensure that the next trade aligns with the trader's tested approach. This alignment restores consistency, and consistency is what allows the edge to produce long-term profitability. Without consistency, even a strong edge becomes useless. Fresh conditions reveal the true narrative of the market. Traders who jump in prematurely often misread the narrative because they are too focused on the last movement. They see a candle spike and interpret it as momentum. They see a retracement and assume it's a reversal. Fresh conditions reveal whether these movements were genuine or deceptive. When the market forms a new trend structure, retests a key level, confirms a breakout, or demonstrates cleaner order flow, the narrative becomes easier to interpret. The trader no longer has to guess or hope. They can see clearly what the market environment supports. Another powerful aspect of waiting is that it reinforces patience as a trading skill. Patience is not something most traders naturally possess. It must be trained. Waiting for fresh conditions is one of the strongest ways to train it. Each time the trader waits instead of reacting, they are strengthening the psychological muscle that allows them to endure uncertainty without panic. This skill becomes invaluable in long-term trading because the market spends more time ranging, consolidating, or forming setups than actually trending. A trader without patience suffers through these phases, forcing trades out of boredom. A patient trader thrives because they conserve capital, conserve emotional energy, and strike only when conditions align. Fresh conditions also reduce cognitive bias. After a losing trade, the mind often becomes anchored to the idea that the market should eventually move in the expected direction. This anchoring bias leads the trader to interpret neutral or even negative signals as positive. But when the trader waits for a completely new setup, the anchoring weakens. Their viewpoint resets. They stop searching for reasons to justify the old idea and begin interpreting the chart with a fresh mind. This drastically improves objectivity. The practice of waiting for fresh conditions builds a healthier relationship with uncertainty. Instead of fearing uncertainty or fighting it, the trader begins to respect it. They recognize that uncertainty is a signal to pause, not to push. They understand that nothing needs to be forced and that the market will always produce another opportunity. This mindset creates a level of psychological balance that reactive traders never achieve.